When I look at who's leading that, I see a couple things, right? First and foremost, look at Bitcoin. We're in a block space bear market for Bitcoin. I think like the runes and ordinals thing never really took off.
This episode is sponsored by SKALE. SKALE has differentiated itself from other layer ones by offering users a network of gas-free, interoperable EVM L1s where the user experience comes first. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at SKALE Network. To learn more about the gas-free architecture and growth of the SKALE ecosystem, visit the SKALE Research Hub at scale.space/research.
Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
He's always gone for the intro. Hey guys, welcome back to another episode of OX Research. Today I am joined by Ryan and Dan Smith from the data team at Blockworks. How's it going, guys? Glad to have you on.
Pleasure to be back. 0x or OX? The question that will live into infinity.
I've always said 0x. Never said O. It minimizes the uncertainty. 0, straight into the point.
I think I probably adapt based on the person who said it before me. So I'm going to say 0x.
And we'll blame Boccaccio. There we go.
I'll respect Ryan on this end. We'll blame Boccaccio and we'll move on. I guess speaking of uncertainty, the markets are certainly uncertain at the moment. Certainly uncertain. Bitcoin and other charts are looking a little red at the moment. I think people, past month or two were very excited, and I'm seeing that some folks are maybe not so excited today or concerned, uncertain heading into the new year. We'll see how that shapes out. I don't know if you guys have any deep or specific thoughts there, but certainly there's been a shift in the mood and the attitude going into the new year.
Yeah, I got a thought. Kind of two observations from the recent drawdown. One is that it seemed to be pretty in line with TradFi markets. There's like a little shift in uncertainty in TradFi markets with respect to rates and kind of growth trajectory, and that's fine. There's also some like year-end price action that just like always happens as people move the book around. So I pretty personally heavily discount December volume, August volume, July volume. So I wouldn't take it too seriously, but like the takeaway with the TradFi stuff is that Bitcoin is traded in TradFi markets now. It's going to be increasingly correlated or increasingly integrated to TradFi portfolios. And so it should look like what happens to risk assets when TradFi markets move. Typically, when you experience, like this is the extreme scenario, when you experience a VAR shock, you're just told to sell the highest volatile things in your book so that you can get your value at risk in line. You minimize your kind of tail risk, and Bitcoin is that classic tail asset. So if you need to trim risk, you can sell a little bit of Bitcoin and trim a lot of risk. So just these TradFi dynamics, I think, are going to increasingly influence crypto dynamics. And obviously it's not going to all happen in one day, but you should see that in the price action going forward. And like you saw today, like the market sold off at 9:30 when TradFi markets opened at 9:30, right? So kind of like no surprise there. The other takeaway is just kind of an observation about the timeline. I don't see people in crypto using drawdown charts. They're pretty common in like TradFi, like orienting around like what's happening in markets and when to deploy risk capital long term. So what a drawdown chart is just you take the current price and you see the percentage change from the all-time high price on a looking backward basis. So what you'll see is just kind of like straight lines, and then when you have a dip below all-time highs, you go down. And it kind of puts in perspective like the current drawdown in context of the historical drawdowns. And if you were trading NASDAQ in 22, 23, and you saw it was down 30%, you saw that was like a typical drawdown for the NASDAQ. You deployed capital. The Bitcoin drawdown right now is like very, very shallow, 10%-ish, when historical drawdowns are, obviously, 70, 80%, but in like during bull markets, they can get as high as like 40%, or sorry, as low as 40%. So, I don't know, a lot of consternation on the timeline in the context of a historically shallow drawdown, would be the takeaway. But like all in all, I don't know. There are bumps in the road. It's crypto. These things happen.
Yeah, I actually just pulled up the drawdown chart when you said that. I'm going to try to share a screen here. But it's funny. That's like the very right curve answer. And I've been telling myself a very left curve story over the past week or so, which is, I feel like general consensus view was probably that the market is going to experience, this like an inauguration centric drawdown because this recent run up has been so presidency and inauguration focused, right? Like the narrative has been Trump won and he's bringing in like AI and crypto heavy people, and that is going to fix the regulation issue that is holding back crypto in the US and therefore kind of push the entire industry forward. And because of that, I was like, okay, that's a hype and speculation piece of this. Inauguration's Jan 20. We'll probably see that drawdown in mid Jan. And like we're just a couple weeks before that, and now this is basically the drawdown we're seeing that we thought we would see then. And so that's the story I've been telling myself at least. But if we can add in this the chart I got pulled up, I think it's actually pretty cool for the context of this. So I don't know, go back to like 2016. But this red draw is the red area chart here is the drawdown. The black line is Bitcoin price. And to Ryan's point, we've seen drawdowns of 80% in January 19, even like in between those two peaks of the July all-time highs, drawdown of 51%. And then in 23, 70-ish, 75%. And, right now I guess I need to zoom in a little bit more here to get an accurate version on the now. We're looking at 7% down from all-time high. So yeah, to your point, Ryan, we really haven't experienced much pain yet, but it does feel like sentiment on the timeline you wouldn't think it was only 7%, which probably shows that general portfolio balancing is like very skewed to tail assets and AI agent coins that fluctuate 30% on a slow day.
Yeah, it's not surprising to see. I think it's expected that the niche kind of participants in the niche community investing in the super risky assets, they're probably further down than 7% on some of their tokens that are not BTC. Maybe for a spot of good news though, or just interesting, we're seeing a comeback of meme coins in a lot of different ways this cycle. One is using memes as like a launch pad for, building out a product, using that as kind of like the initial funding mechanism rather than an ICO. Another that had been attempted or used as a gimmick in the past was using meme coins as a way to raise money for charities. I think a lot of those, maybe in 2021 were not with the best intentions or did not at least get carried out in that way. But we did recently have this past week over the kind of the holidays, the Mira coin was 50% of the supply was donated to a man with a daughter with brain cancer, and he has committed to, I guess eventually, I think it's quite a bit of the supply of this token, so it has to sell it off bit by bit, but selling it and donating that to a Hankinson lab that is specially researches this type of brain cancer, potentially others. So a spot of good news, some joy going into the New Year's. I don't know if you guys, anything deeper on this point. The one thing that I do find interesting is this kind of comeback of like meme coins as like launch pads for building products, as well as, we see this charity thing, I think, pop up. It happened quite a bit in 2021, maybe some dubious, maybe some, actually for the cause. We're seeing a lot of those dynamics play out again, at least.
Yeah, this one was interesting. I don't know. It feels really like gimmicky. Like if you want to donate to the guy, donate to the guy. I feel like there's much better ways to do this, both on chain and off chain. But he did raise like $1 million, and that's incredible. And you probably wouldn't have gotten that had it not been like this. The question is like from a more moral or ethical standpoint, like, did everybody actually know that this was the game being played? Like, I don't know, probably, to be honest. I think everybody buying a pump fund token at this point in the cycle is very aware of what they're doing. And this one was like, had this virality piece in nature to it. So I do think that from a moral and ethical point, like, I don't really think there's foul play here or any of that. And I think you can just kind of zoom out a bit and see that this um, obviously great thing, which is $1 million for rare disease research, has been secured. That said, it's still just like what are we doing here? This is a very strange. I don't know. It's like it doesn't sit right with me for some reason, but I do think like all market participants were well aware of what was going on, and I do think it worked out great in the end result as well.
Yeah, I like it. I think it's pretty interesting, right? Like, imagine if you were scrolling through Twitter and you saw like just a link to donate to a GoFundMe. I don't know. There's a sea of GoFundMe's. Like, it's not that interesting, but like to inject that onto the CoinGecko feed or the Dex Screener feed, I think is a pretty interesting way of getting attention. I'm not saying that like I think that it should be this new form of charitable donations, but like to gamify a thing is often like very successful in getting people to participate more. So perhaps like, I don't know, like meme impact investing or some forms of it is pretty interesting, where you can inject the speculative game to drive like goodness in the world. Because like everyone who lost money on that thing was very happy to, and it probably I mean, this is just like silly counterfactual, right? But like, it probably got more attention than it otherwise would have. So that's good.
Yeah, I think fair points both sides. It's hard to say, on an ongoing basis how repeatable, like to this extent and to this positive extent, this could be done. Obviously, if you had 50,000, charity meme coin launches a day, it would not instill quite the same effect. But at least, in this one case that catches, the attention and the bid, it can be put to good use. I think maybe hinging off of this topic, everyone knows at this point, meme coins are a very significant driver of on-chain activity, fee revenues, and the REV has become a very meaningful metric to us at Blockworks, and I think is starting to become more widely interesting to the industry broadly. But I love this chart that we have showcasing the kind of historical network REV by chain. And you can really see, like in 2021, the significant dominance of Ethereum as a chain at that point in time. And then now looking ahead to this cycle, you can really see the dent that Solana has made in sort of this market share of REV. And I think this kind of the mania over tokens and pump fun and related has certainly contributed, but the kind of shifting of the seas is really apparent, I think, when you look at this chart in broad strokes, especially if we click over and look at it on a percentage basis as well. Dan, I'm curious what your thoughts are just generally about kind of the shifting of REV that we've seen over the past years.
Yeah, when I look at this chart, I actually have a couple takeaways. First, I want to start with like a quick definition and why REV matters. So REV is real economic value, or the amount that users are paying to transact on a chain. It does not matter if it is a base fee. It does not matter if it's a priority fee. It does not matter if it's an out of protocol tip paid to somebody, paid to a validator to land your transaction. It is the amount that users are paying to transact on chain. It is a measure of demand. This metric also doubles as the like top line number for a blockchain, right? People love to know like the revenue and like of a business, and blockchains are not businesses, they are networks. So when you say revenue, to who, right? Are you talking about revenue to token holders, revenue to stakers, revenue to validators, revenue to third-party infrastructure providers? It's very unclear. So you need this more broader term, and REV is that number. So the idea is you can then take REV, subtract out any operator expenses, and the rest is what flows to token holders. And so you do get this like token holder aggregate position of stakers and non-stakers. So people who stake their tokens versus just hold them plainly. And you can get this like net income number as well. So that's why REV matters. I guess one core difference here is it does count out of protocol tips. So that's like, if you look at a top line number on most other data providers, you're only going to see base fees, priority fees, which is the in protocol piece of this. But again, the reason why out of protocol is just as useful, is because it goes to the token holder and it was paid to transact. So again, if you don't have that other piece, you're not measuring the full picture, the full spectrum of demand to transact on a chain. When I look at this chart, I notice a couple things. This is kind of what I'm using as my where are we in the cycle chart, actually. So it's when I look at this and I see, I think it was like mid 2021, late 2021, where we had that $2 billion month of people transacting on chain. That was stemmed by Ethereum and some like crazy high gas prices at the time, like multiple $100s to send a transaction. So it is like a little bit of a misnomer to say, oh, wow, there's that much demand then and there's this much now. There's far more computation happening on chain now, whether that's transaction count, whether that's DEX volumes, whether that's more assets in lending protocols and being borrowed from those protocols. There's way more things happening on chain today. The price to execute transactions on chain has just decreased by multiple orders of magnitude. And so that is like one important piece when I look at this chart. But net, with cheaper transactions, you need to be selling more units, right? When you decrease the price of something by 99% to have the same net value, you need to increase the units sold by 100x. And we're starting to see the very early innings of that. And so to me, when I look at this chart, I say, yeah, there was $2 billion spent in a month to transact on chain back in 21. But today we see far less than that, about 2.5 times lower. Yes, there's more transaction activity on chain, but that user monetary demand has not eclipsed that previous high. And so I do think this cycle we're going to hit a new high, likely in 2025, and probably the early half of that. And when I look at who's leading that, I see a couple things, right? First and foremost, look at Bitcoin. We're in a block space bear market for Bitcoin. I think like the runes and ordinals thing never really took off. There was that Twitter recap, like your Twitter Wrapped, and I think it was by EXA. And one of the quotes it had for me was, you mentioned runes were stupid, like really, really stupid. And that was true. I was kind of loud about that because it made literally no sense. And when we look at the demand for Bitcoin block space, it is very much in a bear market today. So that just like failed to take off. I think the roll up side of things is probably what's going to be needed to make that more interesting again. When I look at Ethereum, I see a successful transition to execution happening on L2s. Base, I think, has flipped Ethereum in DEX volumes on multiple days now and is doing incredibly well. I have another chart I tweeted out earlier this week that was ETH USD, so only looking at the USDC and USDT pairs on all Ethereum L2s and Ethereum mainnet. And the ETH USDC volume on Ethereum mainnet is still about 40 to 50% off its highs from 2021, where that same amount of volume on L2s, specifically Arbitrum and Base, who go head to head for this volume, is like blown past all-time highs. So to me, I see a lot of this SexDex arbitrage has actually moved from mainnet to the liquidity pools on Arbitrum and Base specifically. And very interestingly, it's mostly being driven by a single address. It's like a 01xF address you'll probably see on every single block on either of those chains. Not sure exactly who it is, but they are clearly running SexDex Arb on both Base and Arbitrum. And so to me, that was kind of the goal, was to push execution of the L2s, and that's where we've seen. And from an REV standpoint, that has been costly. Market share has decreased, total value has decreased as well. And the clear, bright spot on this chart, if you will, of a current market participant that has massively grown their market share is Solana. REV is at blown past all-time highs by many multiples. It is now the most REV generating chain in the industry, mostly driven by ordering fees, or those priority access to state fees, which would be JITO tips and priority fees. And they're kind of battling some of those ETH 2022 problems now with sandwiching and harmful MEV. But most of that isn't actually reflected in REV, as there's a single actor who has a monopoly over that space and keeps very, very large profit margins. But net, Solana has absolutely crushed it. They proved the thesis is true, that you can do exactly what I mentioned earlier: decrease cost by 99% and increase units sold by 100x. And if you increase beyond 100x, you actually generate more. So the idea is you significantly reduce the cost, and you'll have that induced demand narrative. So very interesting to see that play out as well. So it's kind of like my 3 high-level thoughts with Bitcoin, Ethereum, and Solana. And just to put a bow on that, I think the one thing that's really interesting is there's been a huge discussion around comparing base DEX volumes to Solana DEX volumes, as those are really the 2 heavyweights today in the industry. Of also, when you're factoring growth from here, Ethereum is very much in the conversation of the DEX volume heavyweights, but a little harder to create that growth narrative when you look more forward looking, again, because that intention of pushing execution onto the L2s. And so when comparing these volumes, Solana still has a very material lead over base. But I think like you can create a very concrete and sound argument for why that might flip. However, when you look at REV, it is not even in the spectrum of flippable right now, which is very, very interesting. So it's kind of like the one metric I like to use, as if, gun to your head, you got to pick one metric to analyze a chain. Like, to me, it's REV, because that is what is being paid to transact on chain. That is like the monetary demand to interact with your economy. And 2, that is ultimately the top line that will flow back to the token holder. So there is some valuation side to this as well.
I've got one more chart for you, Dan, that I think is meaningfully interesting as part of this discussion. Okay.
The suspense.
Incredible that we just did that. There we go. And if we look at newly created tokens by blockchain, I think this highlights a lot of the points that you were making. You can actually see what I find interesting is that in 2021, the BSC chain like quickly and significantly, usurped Ethereum as far as like, new tokens being created and traded. But Ethereum gas fees were, 100x, if not more, higher than that of BSC. And so they continue to dominate from an REV standpoint by a significant margin. And if we look today, like those 2 massive kind of contributors, this doesn't go all the way to present, but if you updated it, I mean, the SOL numbers would continue to grow there. But Solana and Base, the 2 chains you just mentioned, kind of like the top contenders for activity and volume today, have taken up the helm. And this doesn't, like you said, it doesn't fully illustrate the picture that where, since this is percent of newly traded tokens, we're talking about an order of magnitude of more tokens and trading activity occurring to fuel cheaper transactions, leading to an aggregate significant amount of REV for the chain, which I think is interesting. I think this chart is it's an interesting sort of like, you can see the confounding factors in terms of like cost to transact and like relative throughput, I guess, if you want to consider it that way, that sort of interplay into the REV metric.
Yeah, I think an interesting overarching observation for everything that you guys just pointed out was that trading is what matters to the profitability of these things. And like, so what are the implications? People got really excited about Polymarket, right? But it didn't drive a lot of trading volume. So the value didn't necessarily flow to Polygon, or wasn't noticeable on the rev charts, right? Um, so yeah, just something to think about as you get bullish on the chain or you get bullish on the app, where the value flows and what really matters to the chain's valuation.
Yeah, that's a good flag. That's definitely the game that is being played today. So that is very much so what matters. The question is like, how will that evolve going forward? I think DEX activity will probably always be in the discussion, no matter how it shakes out. However, I think there's like a decent opportunity or decent likelihood that it's, today it's meme coins, but I think we'll get more interesting assets in the future. So the other thing to look at is, where are not necessarily just like pump fund style churning them out meme coins being launched, but also like the interesting assets. So whether that's like the top AI agents today, whether that's RWAs, whether that's anything that's just like tied to a project more broadly.
Yeah, there's good research from how arbitrage opportunity scales with market cap. So like the higher market cap things on exchanges, the more arbitrage activity there ends up being, because basically you can do 2 things. You arb the fundamentals, so like play a long-term game, and then you can arb the exchange to exchange activity. I think the study was on the London Stock Exchange. So like you can see, it's just like a super linear relationship, arbitrage opportunities with market cap. So I guess another way to frame it, or like the interesting assets, right? It's like the assets that can maintain these multi-billion-dollar valuations, right? They're going to drive a good amount of REV for these chains as well.
Yeah, I think that actually gives like a pretty good nod to the L2 ecosystem, right? Because like the one asset that you get this trustless bridge with, if you build on an traditional roll up on top of Ethereum is ETH, right? You're going to get your own native stablecoin implementations if you're doing like anything semi interesting, right? We've seen that already with like every major L2, but you can't just arbitrarily mint ETH anywhere. So ETH is actually a very interesting asset for exactly that conversation. And again, like I'm going to pull up that tweet that I was talking about because I think it does illustrate the point of like seeing the amount of success that Arbitrum and Base are both having because of that asset specifically being on chain there. So like, yeah, here's the example. So this is just the dollar value of ETH/USDC across the Ethereum ecosystem, as we have like other chains grouped all into one because very interestingly, that's just like a non-material portion of the volume. And then you have Base, Arbitrum, and Ethereum. And you can see Ethereum, again, still about 40-50% off that previous all-time high in 2021. And Base and Arbitrum just absolutely crushing it right now. Again, largely driven by this one single actor, which is pretty interesting as well. So yeah, there's like this one entity that is doing 20% of fees paid on Base and about 30% of ETH/USDC volumes on Base, and they're doing about 14% of ETH/USD volumes on Arbitrum as well. So it's pretty interesting to see that this player is like absolutely eating. And here's a quick glance at some activity from this player across both of those two chains. So basically this chart is a little bit confusing, but on the top, if anything is positive or above the line, that is a purchase of ETH on either chain, and anything below the line is a sale of ETH on either chain, specifically looking at the ETH/USD pair. And what you'll notice is all of these lines move together. Like they're either buying ETH on both chains or they're selling ETH on both chains. And what that signals to me is this is not cross-chain arbitrage, right? You'd imagine these be going the opposite directions if that was the case. If you buy on ETH, you'd immediately be selling on Base. But instead, this is sex to dex on both chains. So basically the price will move on Binance or whatever exchange, and then this account will like basically take liquidity from both chains almost equally, and then bring that back to Binance, again, whatever centralized exchange, and arb the price that way. So that was kind of an interesting observation I had going through this the other day.
Have you... I guess I would assume the answer is yes, but have you looked in and seen like the transfer volumes there as well? Like, withdrawals and deposits to and from centralized exchanges from this address?
No, I didn't dig through which exchange it is, but that would be pretty interesting. But I don't know if you're going to see it really, because my understanding of how this works is you basically just have, imagine you have $1 billion. You just you wouldn't have that all on one exchange, first of all. And then you would park that, you put $10 million on Base, $10 million on Arbitrum, and then you just like occasionally rebalance that $10 million. So that could be, let's say you're arbing against Binance because they've got the best prices, and then you keep your liquidity on Coinbase because that's who you trust the most. So I'm obviously just making up this example, but it's not super easy to see exactly where they're arbing against. But we're going to build out some more interesting data around just the MEV space more broadly. I don't know. There's just like such an untapped potential there. And there's a couple of great teams that write good papers on this, like Flashbots. The Sorella guys are great as well. But I don't know. There's just like a lot of this is the majority of on-chain activity, and it's like just a bit of an underexplored area, in my opinion.
Yeah, it's definitely a big deal. It's also interesting how it, I understand some things are different in crypto than TradFi, but one of the things that's similar is that one big player will be a lot of the volume. So I think Citadel's like, as of March of 24, someone estimated them as 26% of US equity market volume. I think Virtu in the past has been a similar size. So yeah, the analogs hold.
Hey everyone, we'd like to give a special shout out to the sponsors of today's episode, SKALE. SKALE is built different. Unlike other layer ones, SKALE is offering users a network of gas-free, interoperable EVM L1s where user experience comes first. SKALE operates like the AWS infrastructure model, where developers pay for space in the network in SKALE tokens to validators. Essentially, SKALE has chain fees and not gas fees. This allows for free transactions on Scale and has saved 46 million users over $9 billion in gas fees. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Visit the Scale Research Hub to learn more about the gas-free architecture and growth of the ecosystem. That's scale.space/research. Speaking of MEV then, Dan, I know we have some maybe interesting things to discuss in terms of Sui, or, the Sui MEV scene. I guess, we just kind of discussed, the ETH side, the Solana side, talked a little bit about Base and Arbitrum. I guess what's interesting on the Sui side of things, obviously we're working with Move in a different sort of architecture there. As far as MEV goes, like what are the unique things or the interesting things that you're seeing there?
Yeah, I'm definitely not an expert on, MEV broadly, but specifically on Sui MEV. I think it's interesting and emergent, which is why it's fascinating. And I would call this like a Gen 3 chain, right? Like you had Ethereum, and then you had, Solunavax. So Solana got to learn off all of Ethereum's learnings, going, being, let's say, a full cycle or two ahead of where it was. And then you had these Gen 3 chains like Aptos and Sui that have the same opportunity, but now not only Ethereum, but also Solana. And they're a little bit more relatable in different capacities to either chain. So they kind of have this like broad spectrum of knowledge to build on top of. And that, I think, is the really interesting aspect here, is saying, okay, like what are they going to do differently to avoid some of those headaches that the other chains had that predated them? So specifically on Sui, and I think on Aptos as well, there's like the ordering of transactions is much different. And Sui specifically is a DAG-based chain, so it's like a leaderless chain. There's not like one person who has a monopoly over the ordering of the transactions in a block. So that like already changes the MEV landscape a bit. You've seen, Max Resnick, Tolly, and even a lot of the Ethereum folks saying like, all right, yeah, multiple concurrent proposers is probably a good idea because you have a higher likelihood of someone that's going to do the right thing for you, being the block producer. And so I think the DAG-based piece is super underexplored by the industry broadly. I think the Sui team is obviously very in the weeds of what that looks like. I just honestly don't have a good view into that. But there's a proposal right now, I think it's SIP 45, that basically wants to like introduce the notion of priority fees and priority ordering. Pretty standard stuff, I think, that you'd expect to see on most chains. Versus like block STM used by, I think it was originally created by the Sasha and the Aptos folks, but it's also live on Polygon today. And with like block STM, I don't think you have like super deterministic ordering. So like if a priority fee is, or if a gas fee is higher, you have like an increased likelihood of being higher in the block, but it's not like guaranteed. And so that's like this interesting element. And I could be a little bit off there. I'm not 100% positive. Again, this is just like an underexplored area for me. But it's just interesting to see that, we're starting to see a shift in like, okay, once you have transaction activity, you are going to have MEV, and this is something you have to deal with, or else you're going to have troubles. And the risk of not having priority ordering is you can just spam the shit out of the chain. And, like we just saw this on Solana earlier in the year. If you're not going to like put my transaction where I want it, I'm going to send you so many transactions that the probability of it being where I want is going to be so high, the rest will fail. And it's your problem, not mine, because the transactions are so cheap. The one being executed was profitable to send you 10,000 of them. So that's kind of like the risk you're trying to avoid here. There's also two really good MEV teams building. I say really good. I'm not super familiar. There's two MEV teams building on Sui today, Shio and Aftermath. The Aftermath team I chat with a bit, and I'm pretty like bullish on them as a team. I think they're very intelligent and like critically thinking about problems, which is fascinating to see. But yeah, if you wanted to like dive more, that's probably where I would start, is like SIP 45, and then like what is Aftermath building and what is Shio building.
Yeah, I do think it's interesting to see a lot of the sort of cutting edge of tech that's being, sort of chased after in the industry. Has, we're trending in a lot of the same directions, right? The discussion of priority fees there, trying to parallelize certain things, the research around MEV, like you see a lot of little bits and pieces get adapted and like, utilized in different architectures in different ways. But ultimately it comes back to the same idea of kind of chasing after these same opportunities that kind of like represent themselves over and over again.
Yeah, there's also this super interesting thing that I just noticed happening. I think it was 0x Evan on Twitter who posted about this. But basically, so there's on like these high throughput chains, you need state access becomes like this bottleneck for execution. So you basically need to make people pay for it. Solana, Sui, Aptos, they all have this where there's a fee to place a deposit. Not yet, nice. There's a fee to place a deposit on opening or creating a new piece of state. And that fee is like mostly a deposit that you will receive back once you close that piece of state. I on Sui, what's happening right now is they've figured out a way to swap the owner of who paid that storage fee. And why that's interesting is like an order book. So, let's say I'm a maker and I want to buy like one Sui at $4 or whatever. And I place this order. I create this piece of state that contains this order. I paid some small amount to execute the transaction, and there's an additional fee that's this like storage deposit. On like Solana and Aptos and even Sui, historically, all I've ever seen was that storage rebate goes back, or the rebate for the storage fee goes back to the original owner that opened and created the state initially. However, I think it's the Aftermath team created a way for that deposit to swap hands. And so what this means is like a maker can open an order and the taker could close that order by executing their trade and actually get the rebate. And the rebate is sometimes larger than the transaction fee, the execution fee. So you basically get this like negative transaction fee, or you're paid to execute the transaction because you are taking somebody else's storage fee, which is really, really interesting for market makers or just takers more generally. So I haven't really fully wrapped my head around this piece either, but I have never seen it before. And I'm always intrigued by like unique uses of blockchains, and especially in this case, the storage fee specifically.
And in this case, I'm not entirely certain, but like, could you liken it to something like, state rent on Solana, where, you can burn an account and get back the SOL for the state rent of that token,
Yeah.
or is this a different mechanism?
It's the same concept, right? You're making a deposit to create some new piece of state, and then when you close that piece of state, you get the deposit back in full. That exists on Solana, it exists on Aptos, it exists on Sui. I think the innovation here is figuring out that you can actually change the owner of who put that deposit down, and therefore, like if you let's say I'm making up numbers, but let's say you paid $1 to execute the transaction, and you got a $3 rebate. You actually just, because somebody else initially paid that rebate, that storage deposit that you're now getting as a rebate, you actually made $2 by executing this transaction, regardless of like what activity you took.
Is there so this kind of concept exists on other chains, but it's only being like done in mass on Sui today? Is there any reason why that is?
I don't know if you can change the owner of this storage deposit on other chains. I haven't seen it before, so I don't know. I genuinely just don't know if it's possible or not. So yeah, I don't have a good answer because I genuinely don't know.
Yeah, I guess that it would be an interesting question. The only like cases where I understand this on Solana is if you sell out of a token, or get rid of an NFT or what have you, you could burn it and get back the state rent, or remove that the token account associated with it, for example.
Yeah, and order books never really took off on Solana. Phoenix was the best implementation we've seen, and they do about 5 to 10% of DEX volumes. Most of their activity comes from stablecoin swaps, which is interesting. We break out that activity actually on the solana.blockworksresearch.com dashboard, covering all of Solana's DEX activity. But I think most of their issues were convincing. This is my interpretation, I don't know for sure, but it seems like market makers were pretty hesitant to market make on chain. It was expensive, and there was this latency component. They didn't always get their transactions to land in a timely manner, and that would cause them to have a worse experience, and they just weren't interested in doing it. I think this is why the Ellipsis team who built Phoenix is also building Atlas using the SVM, but kind of building their own construction as an L2 where you can get better latency insurances. So point being that market order books never really took off on Solana, as they seemed like that was kind of like an initial idea of something that could take off. So one thing I'm definitely paying attention to is, does this happen on Sui and Aptos?
Great stuff. Maybe one last topic for today then. I think we've gone deep enough on MEV and getting back some state rent. The talk of the town, I guess more generally, has been a lot of AI and AI agent related conversations. Some people are absolutely crazy about them. We're seeing lots of people, I think, whether you're interested in just the developments of the LLMs. We had, OpenAI, their new model kind of make headlines with, new sort of like math capabilities that were unexpected, maybe this quickly. Regardless, I know the Send AI team has just done they're doing a Solana AI hackathon. And there's been quite a few submissions. With the speed with which a lot of these have come out, I think it's a lot of quick, like bare bones attempts to put together integrations and different things. So, but hopefully we will see some interesting products kind of come out of these. I know, Ryan, you've been sort of digging in the AI and agent trenches a little bit. Be curious to hear your takes on sort of maybe where we're at, where we're going, what you think.
Yeah. So spent um, a good chunk of time lately kind of diving into this AI agent space. I I was a little late just on the narrative. I kind of like, well, actually, like we started out early. Remember, Danny? Like we actually had like an essay up saying like there's going to be a pump.fun of AI agents, and then we just like didn't launch it. It was either in like late October, early November, or something like that. Like this was all the team kind of first saw it. Unfortunately, like we didn't publish it and we like weren't loud about it. But then I think by the end of the month, like AI 16Z was ripping and like people were launching agents and or AIXBT, I think is the name, like that was up in making a storm, right? So a lot's happened. We were early on it, then we kind of forgot about it. Now we're back. Um, After doing a deep dive, um, I got to be honest, like I'm bearish on what is on the market today, but I'm pretty like I guess bullish on what's possible or like can be going forward. Like I think what's objectively going on today is basically an extension of either the meme coin game or you know, it's just another subset of like crypto native trading games where you have crypto native capital that's very degen, that is very short term time horizon, that wants to make return and play funny games on chain. It drives a lot of the builder attention in the space, and right now it's driving that attention to AI. I think that's like objectively true. Um, if you're looking at the things that these AI bots can do today, it's basically just what they could always do. They can talk to you, they can, print media, but they're talking to you from a Twitter account, right? And that's cool and it's exciting, and sometimes they take on a life of their own, but like from an investment perspective, like you can't do much there other than play like the crypto native trading game with these coins, right? So if you think like that AI 16Z, they have a team, they have kind of a product vision. You have to get in at like a $1.2 billion valuation or something like that. Like that's tough to justify, I think, for anyone. So you have to play the trading game. You can't play the investor game. I think that what can be after like poking around and giving this a think is that like there's kind of two ways that you can think about the space. There are like action based agents and creator based agents. And actions still seem far away, right? So like from a Web 2 perspective, like actions would, be a sales agent, a marketing agent, in crypto space, like a trading agent or financial decision making agent. If you listen to what Satya Nadella says about actions, like he doesn't instill confidence that they're going to happen in 2025. If you listen to the BG2 podcast, they had a good interview with him. Brad Gerstner is very excited about actions in 2025. Satya doesn't seem to be. He kind of tempered expectations. So I think actions are could be further away than people think. Um, then the other side of the spectrum, you have like creator agents, which just like generate content. And I think that that's like pretty interesting, right? So we're seeing what the Cerebro team is doing, where they're generating content and they're like creating an AI native influencer. And no, it's not a perfect agent, right? There's some Flintstoning going on. They're like, making this puppet like work in the background, but it's like pumping out real music. It has like 100,000 monthly like listeners on Spotify. It's selling NFTs. Like you can kind of see like the beginning of something potentially interesting there. Um, so like what's more near term, these things can already create content. I think like creator agents are much more likely. I think in 2025 they can drive a lot of attention because like they have a token and tokens are like really good at driving attention. So Yeah, not much today. I'm excited to see who the winners of the Send AI hackathon are, because there were a lot of submissions and you have to wade through like a lot of really thin wrappers. And I don't want to disparage thin wrappers. I think a lot of thin wrappers are going to be really, really valuable, but these are extra thin, a lot of them. So right, they're just people trying to get in quick submissions. So I think the judges will like do a good job of curating that for us, and then when they announce that in early Jan, we'll be able to get a good look at what that hackathon was all about.
Great points. I think maybe to your points about sort of the creative versus action-based agents. The thing that I would point out is like on this, I do think that a lot of the creator-based tokens have entered this like meme coin trading based kind of paradigm where like you said at a billion FDV today, it's really hard to value that thing on like fundamentals or whatever. You're looking at the momentum, you're looking at can this continue to grow its attention via integrations with if it's the music, if it's other social media platforms, what have you, and can then that via the sort of trading tokens as an attention economy, can that drive its value higher in like this kind of reflexive flywheel thing where price drives the narrative a little bit. And I agree with you there. And I think on the product side as well, like it's very early, but I do think that this is an area here where like the action based agents and like products built off of that. Um, I would not mention any of them here. They're all very low market cap and it's very early, like very simple, like you said, wrappers on models essentially to do things on chain. But I do see those eventually evolving into, generalized products that one might use to interact on chain or with DeFi. Kind of like how you might look at like a Telegram trading bot today, where users aren't, in a lot of cases, these people aren't going directly to like the DEX front end. They open up Telegram and they're like, what are the trending tokens, and they buy the token right there in the app. And I think that these wrappers and these tools, like the fact that so much of this is getting built open source, like it's really speeding up the development timelines, and we can see a lot of this stuff get built out really quickly. How good and successful it is might depend on like, can they get hallucination rates down, like can the more powerful models get released to the public at cheaper prices basically for compute. That's going to be where like the real gains are made, but at least building out all the integrations makes more of these applications possible.
Yeah, I mean, one of the things you also just said there, which is very true, is that a lot of it's being built open source, and that's great for development, but generally not great for value accrual. So like that's the other thing here is how much of this price appreciation is rotational crypto games that we very much have in this industry versus pricing in the actual likelihood of this thing A, being useful, B, winning, and C, making money. It's probably way more of the former than the latter. But like, and that's also not to say like this is going to be the narrative probably for the rest of the cycle. AI is very real and it's like forefront of everybody's mind, and the overlap with crypto is certainly an obsession of the industry.
What do you guys think of the platform plays, things like virtuals?
I think they probably have the best shot at that last piece there, which is value accrual. I think Virtuals has done 50 million in revenue, something around that. They take fees on the trading volume and launching agents through their platform. That kind of feels like something pretty interesting. Versus an agent itself which is sort of like a problem. I think it's like, all right, well, we can make money from launching these things, but we aren't really sure at what these things are going to do, how good they're going to be at that thing, and how that thing is going to make money. So I don't know. You really got to squint at it and use your imagination, which feels a ton like DeFi in 2021, where 95% of the shit launched was totally useless and circular Ponzi's, but they were fun and they got a lot of attention and they traded at ridiculous valuations. But if you bought any of that stuff at the Pico top, you were tremendously down still today, many years later. This is probably like my best mental model is 95% of it's going to not end up working, and that's a-okay. That 5% is going to be really, 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 really interesting.
50 billion is a lot. I'm actually pretty shocked by that number, and the reason I'm shocked by it is I feel like the AI agent tokens are like inherently like lower frequency from a launch perspective than meme coins. where like, you know, a meme could be like a simple picture or a phrase, and those are like, you know, you can spit those out infinitely, whereas like AI agents are like a fine-tuned thing that needs to, you know, act and can act kind of indefinitely to get attention, and therefore you probably need fewer of them, or you need to launch fewer of them because fine-tuning everyone is tough, and finding the compute to sustain everyone is tough, and launching infinite Twitter, like there's more frictions in launching, playing the meme coin game with these agents. So I would think that naturally you should see less token curation and therefore revenue coming out of virtuals than a pump fund. But 50 million already is a very big number. I wonder if the pricing model just very different than what pump is doing.
Now you're making me really second guess this number. But let me. I'm gonna try to pull it up.
I see it here on a Dune. A Dune picture or a JPEG on Twitter, but I can't find the actual dashboard.
Yeah, I mean, okay, you're right. That is a big number, and I cannot actually sit here and confirm it. So
Because pump fund
red
is only
flag.
300 million, right?
I think it's just crossed 300, and virtual's been around for like what 6 months, and really seen traction in the last 2-3. That does seem like a high number, and it is lower frequency. We have this on our public dash for base, which is optimism.blockworksresearch.com/base. And if I scroll to the DEX activity page and scroll towards the bottom, we have a virtuals breakout. And on this tab, I mean, there's about 100 new token mints a day right now, relative to pump funds 40,000.
I've heard the tens of millions of revenue number for virtuals a bunch. I just can't find the source.
If I would have to maybe double check their sort of like bonding curve achieved mechanism, but if they're able to keep the trading in the pools on their platform and they're capturing a portion of volumes like Pump Fund does, for example, there's an opportunity here where maybe they're capturing all the sort of fees that maybe Pump Fund would be getting if all of their tokens did not graduate to Radium.
Yeah, that's a good point.
So there's a potential that
they
for
could
a few they
potentially
get
learn from
big.
Pump Fund's mistake.
Potentially, yeah. Like if they've, and I think we have. Dan, do you have that one that shows percent of trading done on the platform?
So it's broken out by token, and most tokens are 100% still on platform, and then I think like AIXBT is now about 50%.
Yeah.
If you're another DEX, you're gonna try to pull some of that your way as well.
So maybe they did in this case learn from Pump Fund, sort of, if you want to call it a mistake, in that if they're able to keep more of the volume, like be the main DEX basically for these tokens, then they can continuously capture the fee revenue on the volume.
Yeah, and I'm also just thinking out loud about like counting that revenue number. Like, what if someone on their Dune dashboard is applying the current virtual's price to the virtual denominated revenue?
Yeah, I just found the dashboard, but I'd have to read through the query to know what they're doing, which I'm not going to do live on a podcast and put everyone to sleep. But that's a good point too. Oh yeah, okay, they are. It's the virtual daily times the current price.
Okay.
Daily as a time series or daily today?
And this is actually the today.
So they are calculating it incorrectly.
I've looked at this query for 10 seconds. I don't feel confident enough to give you an answer live on a podcast.
Well, we'll do some investigating and come back with it.
We'll do some DD. We'll talk about this topic again on another
we'll
episode.
follow up on this one next week.
And maybe the result of that combo is that virtuals is under or overvalued based on these revenues.
I mean, that says a lot about. I mean, like we were able to figure this out in like 30 seconds, just like a little think. We put a think together, and I don't know. I see a lot of revenue bear posting on Twitter.
It does open the interesting question for like the Pump Fund, where I know there were comments a while back, maybe a few months back, where they had talked about kind of wanting to become the sort of the DEX for all of the tokens that are launched on the platform. There is clearly quite a lot of revenue that they're missing out on, right? That 1% fee on all the volumes that make it off of Pump Fund and onto Radium, like that would be, I mean, their revenue today has been incredible in this sort of first year, like 300 million plus. I think you mentioned, Dan. I could not imagine what that figure would be. Potentially
Let's take the other side here. They would have had to build Fork and audit and whatever their own AMM, and this got them. I think it's like 2 or 3 people. They got to launch almost immediately with no other build. Now, should they have like brought that into themselves? You could also argue no there, because benefit like driving value at Radium is probably socially positive EV. You're like lifting up the ecosystem, grow the pie, blah blah blah. But I think it's actually an intriguing way to get to market at the bare minimum. So like that's kind of the value of shared state, right? You get to just plug into other people and you don't have to build things yourself. And if you like really zoom out and it's like, yeah, we made 300 million, we could have made 375. It's like, okay, you made $300 million in less than a year.
That's a good point. It probably really accelerated Pump's go to market. Without that existing infra, it's pretty hard to do what they did.
Yeah, and imagine they spent the time building it themselves and somebody else beat them to market and then they never existed.
Yeah, to that point, I think there's other ways that they're going after additional revenue opportunities. Everyone and their best friend has built like a Telegram trading bot, for example. You've got BonkBot. There's a million of them. I know Pump will probably continue into product lines like this. It offers another way for them to capture continuous sort of like fees on volume. So there will be other opportunities for them. That I don't think they have to be sad that they only made 300 million so far. Awesome. Yeah, let's we'll double check these revenue numbers on virtuals. Any other takeaways for the audience before I think we call it here?
No, I mean, just to put a bow on the AI agent stuff, I mean, I think the AI trend will aggressively continue. I think you can pragmatically look at everything that's there, and it's like, we don't have a ton today, but it's like, you can easily concoct why it's an interesting future, and that is exactly what we did with DeFi in 2021.
Totally. Co-sign.
Totally fair. Lots of optimism. People are excitedly speculating on future values. So not surprising. That's kind of the standard for this industry. We love, very high prices for things. It gets us very excited. So thanks to everyone for listening. We will see you all next time. Thanks for coming on, guys. Thanks again to Scale for sponsoring today's episode. If you weren't already planning to, make sure to go check out Scale's ecosystem. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. And visit the Scale Research Hub to learn more about the gas-free architecture and growth of the ecosystem. That's scale.space/research.